morning, everybody. Welcome to the BMT Tax Depreciation webinar for investors on property depreciation today. My name's Bradley Beer. I'm the Managing Director of BMT Tax Depreciation, and what I'm going to do today is give you a little bit of a rundown on a bit about depreciation, why we do it, how we do it, and really about what sort of difference it makes to you guys as investors if it's actually done properly as opposed to not done properly. So we'll also talk a little bit about enough information to arm yourselves, hopefully, that when you're buying and looking at properties, you'll be able to know enough to know whether or not you should, what sort of numbers you might be able to get, and just help you to gain a bit of understanding of how this works. We find a lot of investors are not maximising this deduction because they don't necessarily know as much as they can. And you don't need to know how to do it, you just need to know that it exists and make sure you get it there, but help you get it done. We'll give you a bit more insight today is the plan. A little background on BMT. Myself and two other owners run and own BMT. There's about 170 of us nationally and we do depreciation schedules is our game. That's what we do all day, every day. We're quantity surveyors by trade, so we estimate construction cost of buildings. But at BMT, we specialise and basically do lots of depreciation schedules. Now, a little, if I can get it to work, a little bit of housekeeping to start with. Any questions you've got through the webinar, I'll try to leave a couple of minutes at the end to talk about any questions that are sort of generic that I might be able to answer. Anything else, we will we'll answer within the next 24 hours via email. And look, later on, if you've got more questions, feel free to email them in, and that would be fine. I'll only answer them generically, so don't be concerned. I won't give you names out or anything like that. Now, why do we invest in property? Well, it's really all about making money out of property, and there's a few ways we can do that. We want to get minimise our interest as best we can, and we're always trying to do that. Minimise the expenses, maximise the income and the rent, trying to pay out things we don't need to. It's also about making sure you take advantage of all of the tax concessions that the government in this country allows us to do. We find that about close to 80% of investors are not maximising the depreciation, which is often the really easily missed deduction that people don't get. So we're going to teach you a little bit more about how to make sure you do get hold of that today and make sure you're taking advantage of it. What is it? It's a hidden cash flow for all property investors. The building's getting older, it's wearing out. The tax office says that based on that, we'll allow you to make a deduction for part of the cost of the building each year. What it actually costs to build that building, well, the tax office says that you can claim a bit of that, basically. It needs to be an investment property in order to claim it. Residential, commercial, we did the big rocking horse in Adelaide the other day, for example. Any type of investment property potentially has this depreciation available. The only one that's excluded is your principal place of residence. So when you live in your house, you can't make a deduction for that. If you move out of your house and it then becomes an investment property, then that's one that's very often missed. Then it becomes an investment property, you'll be able to claim this depreciation. So if you've moved out of it, then we can have a look at it and make sure we can get some deductions for you if that exists. The other one is if you actually operate a business from a premises. When you operate a business from a premises, it's seen as your own property, but it is a property that still is able to take advantage of depreciation. Now, in order to get an indication of what it means to an investor, I think the easy way is to look. Let's just take a couple of examples. One in particular on a nice looking new unit here, and say what happens if we claim depreciation and what happens if we don't claim depreciation. What does it do to the cash flow for an investor? Now, we'll take a simple unit here. Now, the numbers could be different for different properties, but just to make it easier, I'll just get some numbers in here that are sort of round numbers. And let's say it's bought for $450,000. From that property, we want to get as much rent as we can. We've got to play with the market and get the amount of rent that the market's prepared to pay, of course. Let's say that's about $440 a week in this situation. What that means is we're going to have an income then of about $22,880 per year. Great, got some income, but unfortunately then we've got some expenses. We have to pay the bank back. Otherwise they're going to come and take it. We have to pay the rates, the management fees, the things in order to keep this property. On this scenario, let's say that's about $38,000. Not fantastic. It's costing $15,120 per year to keep this property out of the back pocket, or about $291 per week. It's a bit negatively geared, not a fantastic scenario there, but it does get a little bit better, but it's just some numbers to play with. Now, if we don't claim depreciation, we still, the tax office allows us to at least make a deduction for the loss because we're operating this investment property. So what that means is that $15,120 that we made as a loss, we paid out $290 a week. If we're on a 37% tax rate and we can write our losses against that other income, our refund for the year is going to be $5,594. Our outlay for the year, $9,526. Cost to own the property now is $183 per week. So simply that's a loss written off against your other income, and if you're on that marginal tax rate, it'll mean it'll cost you $183 a week to own this property. If you're on a higher or lower marginal tax rate, then those numbers would be a little bit different. We do run some other scenarios. I think there's some available on the website that run it at different rates, but we can even talk to you about that at a later stage. But 291 back to 183. It's a little bit better. Still $183 a week out of your pocket though. We've had a look at this particular property and we believe the deduction in depreciation in the first financial year would be around $15,500. So what that means is we're going to make two deductions now. Well, one big deduction. One is for the loss, $15,120. The other is for the depreciation of the building getting older and wearing out. The difference with this one is it's a non-cash tax deduction. That other money, the $15,120, you pay out. The depreciation, the building's getting older and wearing out, so we make a deduction for it. Total deduction now is $30,620. If we still have income in that 37% tax bracket, then our refund now will become $11,329 or $3,000, and our outlay for the year is $3,791 or about $73 per week is the cost to own this property. Difference between those two figures, $110 per week. Now the only thing I changed was I maximised the depreciation and claimed it properly, and it made a big difference to the cost of owning this property. Trying to get an extra $110 per week of rent is something that's going to be really difficult. Your property will probably sit there vacant because you won't be playing with the market. Depreciation makes a big difference to the cost of owning the property, so you want to make sure you take advantage of it properly. Now, one of the biggest questions that people will first ask me when I talk about depreciation or they've bought a property will be around the age of the property. People often think that their property is too old to claim depreciation. I want you to get old out of your head. Forget about the fact that old property, well look, don't get it out of your head completely. Old property still has depreciation. It's not as much, but it still gets deductions. Look at this old house here. $300 a week rent. I'll go through this one a bit quicker. With $300,000 purchase price, $280 a week rent, cost to own at $183. Now we get to claim that loss again. Means it drops it back to $115 for the year. But when we claim this depreciation, which is not as much, it's $5,000 in this case, it still drops the cost of owning this particular property back to $80 per week. Difference is still $35 per week in the cost of owning that property for the year. It's still a few dollars. Now the depreciation on the older property runs out a little bit quicker. It's not as much as the new property. What I want to make a point of is that it's actually still there and you can still actually get some. I want to make sure you do take advantage of that. Why does a quantity surveyor get involved in this process? Well, the reason we actually do it is why does this, quantity surveyor traditionally estimates the construction cost of buildings. I've done a building degree, come out as a construction building or a construction management degree, as have a number of my guys in the office, and girls, sorry. The ATO wants someone who knows about construction costs involved in this process. Traditionally, we estimate construction costs as quantity surveyors. The ATO says where all of your actual costs aren't available, they'll accept an estimate, they'll recognise an estimate of construction costs by a relevant professional such as a quantity surveyor. It also states accountants, solicitors, real estate agents, and especially valuers are not recognised to estimate construction costs. Valuers put values on houses. They don't know about construction costs generally. Real estate agents, they sell houses. Solicitors, accountants do your tax. We'll talk about the accountant a little bit more in a moment. Accountants do your tax. They don't estimate construction costs. That's why That's why the quantity surveyor will get involved. Also about maximising the depreciation, we need to make sure we get the most out of it, and it's about some methods of costing, and not just knowing how to cost buildings, but knowing the tax rules and knowing what we need to do to get the most out of it. Obviously, we want to minimise the risk to you and also to your accountant. So we're members of the appropriate associations. ALQS is the Australian Institute of Quantity Surveyors, Royal Institute of Chartered Surveyors, which is another thing we're members of. The AVAA, we're actually plant and equipment valuers at BMT. So we can actually value the plant and equipment within a building. We're also a tax agent for the purpose of depreciation only. We don't do your tax returns, but we needed to become a tax agent. The Tax Practitioners Board are trying to make sure that quantity surveyors are doing these things properly, so we had to go through some rigmarole to become tax agents. Now, the second most regular question for us is, doesn't my accountant look after that? People think that their accountant does all their taxes, and their accountant does do their taxes, but some of the numbers come from somewhere else. We're your accountant's friend. We work alongside the accountant. We do a report that gives him some numbers, or her, to put in the tax return for a property investor. Most of the time what happens is, if you don't know about depreciation, you'll probably go back and ask the accountant to do your tax return. The accountant will often say, yes, go off to the quantity surveyor, BMT we hope of course, go off to the quantity surveyor and get a depreciation schedule organised. We give him a number for the tax return, which was that $15,500 in depreciation. And he doesn't know about construction costs, so he knows he shouldn't do this most of the time. We'll come up with those numbers, so we work alongside him. I'm going to talk about the old property again. It's never too old to ask the question. Always ask. There may be some deductions there. When do we apply this depreciation? Well, look, before you buy something, you really should look at crunching numbers on whether you can afford it, and you've got to crunch a lot of numbers about what you've got to think about the area you're buying and the investment, the underlying investment that you're actually purchasing. But then you also want to, estimate the construction cost. Sorry, you also want to estimate the cost to own this property to you on your tax rate, in your situation. Can you afford it? In order to do that, you really need some sort of depreciation number. Now, we've got an online calculator that's an app and an Android and all those things that you can use to do that yourself on anything. But sometimes we've done something for the developer when they're selling the project or something like that. That's an estimate. But you can call us anytime and we'll talk to you about your property and give you for free an estimate of what sort of deductions you might be able to get. Use the calculator online first if you're just looking at a whole bunch of properties. But if you've got one that's pretty close and you want some pretty close numbers, we do a lot of depreciation schedules. We've probably done a house similar, so we'll probably give you a pretty close indication over the phone for free of what sort of deductions you might be able to get. Now, if you're an existing investor, which many of you will be today, and many of you have had depreciation schedules done by us, but if you haven't, or you've got other properties that are old that you didn't think were worth it, the ATO will let you go back and amend some previous years of deductions. So it's a bit like, if you don't pay your tax, the tax office will make you pay it eventually, and they won't be very happy about you, and they'll find you out and make you actually claim and make you pay the tax. Works a bit the other way for you as well. If you don't claim depreciation properly or don't claim the right things you can claim, you can go back and amend some previous tax returns and get some money back from the tax office. So if you're not sure that you're maximising that deduction, have a look at your tax return, see what you're claiming. We can easily look and see whether we think that's as much as it can be, and you can go back and, even if you're claiming something, you can claim the difference if we go and actually get it done properly. It's pretty easy to adjust 2 years of your tax return on that. Now, new old refurbishments, whether the property is new or whether it's old, we get to claim. If you refurbish a property, you change what's there. So you therefore change the cost of what's there, you change what's available to depreciate. I always like to mention around here that the guarantee. If we do something for you, or we talk to you about your property and give an indication of what sort of deductions might be there, if we go ahead from that and we think it's worth actually going and doing a depreciation schedule, we'll obviously charge you some money to do that then. And we will always make sure that it's going to be worth it for you by saying, if we can't get at least twice what we cost in the first full financial year in deductions, we'll give you the money back. just to make sure that you're very comfortable that you're actually going to get something out of this, or you don't have to go ahead and do it. And if you do go ahead and we're wrong, we'll back that and we'll give you back your money. Now, I've blanket called it depreciation so far, but it's split up into two main areas. The first is what we call the building allowance, or the Division 43 allowance. This one is the hard stuff, concrete floors, the walls and the roof, the things that last a long time. So what this deduction is 2.5% of the construction cost of the structure. So it's available to both new and existing properties, but there is a specific age here that matters as to whether or not we get to claim this. It needs to be built for a residential property after 1987 now, basically. So anything that's built after that date, we estimate a construction cost of at the time it was built, and you'll get to claim 2.5% of that as a deduction for 40 years. This also applies to renovations. So if you've got a property that's built in 1927, and then in 2005 someone adds another room and a new kitchen and a bathroom, whether it's you or a previous owner doesn't matter, we can actually estimate what that cost at that time if you don't have the actual costs available, and you'll be able to claim this building allowance deduction on those items. How does this one work? Let's say, take a house here. Let's say it's built in 2010. Let's say it costs $260,000 for the structural component of this house. The allowable building allowance is 2.5% per year, or $6,500 per year for 40 years. So if you bought this house now, you wouldn't get to claim the first 3 years. You just get to claim it from when you own it. And you'll be claiming it up to 2050 because it's got 40 years of claims. How that works is it's 40 years times the 2.5% per year, meaning you're claiming the full $260,000 over the 40 years if you still own this property in that period of time. If you buy one now that's 10 years old, it just means you've got 10 years left before it actually, 10 years old, you've got 30 years left before it runs out. Commercial's a little bit different dates and things like that, and sometimes different percentages. Website's got all those percentages available. I won't go into those in detail today. Plant and equipment is the other part of depreciation. This includes things like dishwashers, stoves, hot water services, stoves, all of stoves, blinds, curtains, air conditioners, things that last not as long. Now the tax office puts out what they call an effective life on these things and says some things are going to last 10 years, 12 years, 5 years, 20 years. So there's a percentage that relates to how long these things are going to last, because generally these type of things we're talking about don't last as long. You know, dishwashers don't last as long. The dishwasher the other day, 5 years and 3 months old, broke down, had to buy a new one. Of course, the warranty was 5 years. My brother had the same one at the same time, funnily enough. 5 years and 4 months his lasted. Now, we'll come back to that example later. Think about those dishwashers. They broke down after 5 years. I had to throw it away and get a new one. Anyway, plant and equipment doesn't have an age restriction. There's no special 1987 date or 1985 date or whatever date that says you can or cannot claim a deduction against plant and equipment. The thing with plant and equipment is, though, it needs to have some sort of value. So if that house that was built in 1927 still had the original carpet, going to struggle to put much of a value on it because it's not really worth anything. But if you buy an older property now, like that old brown brick house we saw, generally a lot of the things have been replaced. The carpet, I hope. The dishwasher has probably broken down, hopefully not in 5 years. The hot water service has probably been replaced at some point. So we go in there and we give an estimate of the value of these things at the time of purchase, and you get to claim a deduction based on that. So it doesn't have an age restriction other than we need to put some value on it. So when we're calling you up, or you call us up, and we talk to you about your property and see whether it's going to be worth it or not, what we do is we ask you a few questions like, you know, is your carpet from 1927? Is your hot water service from 1927? Or what is it? Oh, no, it was replaced 3 years ago. Well, that's usually some of the answers, and we can identify whether we believe we're going to get some deductions from it. Plant equipment example here, dishwasher, for example, is an item that is plant and equipment. Let's say that costs $1,350. It has a rate of claim on a diminishing value of 20%. I mean, the first year, if it's a full year, is $270 in claim. And then it diminishes from there. And there's a prime cost rate's the other method, but we give you all of those just to give an indication that, you know, 20% is much better than 2.5%, so the more of those things we can find, the better. Now, I'd like to touch on something that we deem, it's not really the tax office word, but we deem it scrapping because it makes it a bit easier to understand. Scrapping relates to the removal and disposal of depreciable assets within a building that you're throwing away. So if you do some renovations, or think about that dishwasher again that broke down after 5 years and 3 weeks or whatever it was, what happens is you throw some of these things away that still had some tax value, some depreciation value left. They become an instant tax deduction potentially in the year that you throw them away. So obviously it needs to be an investment property. The same applies here. But think about my dishwasher. A dishwasher should have an effective life that's more like 12 years or 10 years, really, the tax office puts on it. And those have changed over time depending on how long you've owned the property. My dishwasher broke down after 5 years. So what happened was, it wasn't economical to repair, so I actually threw it away. So I'd claimed some of the depreciation on that dishwasher, but I hadn't claimed all of it. What I did then in that financial year, even though I'm annoyed about buying a new dishwasher, at least I got to write off the residual value of that dishwasher in that financial year. Then I put the new dishwasher in and start claiming it. Now, I had to throw that one away, but sometimes it might be because you decide to do a renovation and you throw a bunch of stuff away that was still okay, but you wanted new stuff and better stuff so you can get better valuations and better tenants. You're still scrapping things by choice. So providing it was income-producing property, you throw these things away, they had some value, they could mean an instant tax deduction in that year. The important thing here is call a quantity surveyor first before you rip it apart, because we want to see what's there before we throw these things away so that we can see, put a value on these things, and if the tax office asks questions, we've been out there, we've inspected, we've had a look, we've got photos, they're in place, and we can see what they actually are. Scrapping can make a big difference. Always call a quantity surveyor before you pull it apart. How do we maximise deductions? How do I get the most out of the property? Well, obviously the more dishwasher type stuff that I can find, as in plant equipment, the more deductions I get in early years, because I get 20% out of a lot of those instead of 2.5%. We need to talk to the ATO and obviously the accounting groups. We need to know what's going on and we need to know the rules and make sure we keep up abreast of those. The method by which we cost things for the purpose of depreciation is a bit different to the builder just going down to Ream and buying a hot water service and putting it in your house. You might think, hot water services seem to be quite expensive on depreciation schedules of yours, Brad. I think I can buy a hot water service cheaper. The fact is you probably can, but they have to bring it back, they have to install it, they have to do a lot of things to get it there, part of the cost of preliminaries, consultants' fees. There's a bunch of costs, and you pay a premium for this. You buy a house ready to cook, so that your tenant can move in and cook water and have a shower on the first night. You pay a premium for that, you get to depreciate based on that. That's why the hot water service has more value on it for the purpose of depreciation. Furniture. Furniture is plant and equipment. So if you're looking at furnished property, think about the depreciation that may be available. We can give you estimates, of course, on that. If you've already got a furnished property, then obviously you want to make sure you claim the furniture as well. We'll always ask if you've got furniture, and we'll include it in the depreciation reports. Strata in common areas. If you're in a unit complex of some sort, under the strata rules, you should own part of the common areas, which you will get to depreciate, and you get to claim your part of that. Lift is an expensive item in a common area. You want to make sure you pick that up. So we assess all the common areas. Underground car park, expensive area, expensive item. You own part of it, probably at that 2.5%, but all these things add up to make sure we get the most out of it. The process of a depreciation schedule. Spoke to a few people about this morning already that rang up to order depreciation schedules. It's really what we want to do is make it very simple and easy for you. We talk to you about your property first. We want to make sure it's worth it. How old is it? Is the carpet from 1927? How long have you owned it? And a few questions like that. If we believe it's worth it, then we want to go through and say, yes, let's go ahead. We arrange an inspection with your property manager. So you don't need, sometimes it's good if you just let your property manager know that we're going to call them. After that, we talk to the property manager. We organise a convenient time with the tenant. We organise to go through the property and inspect it. Now, every one of these inspections by BMT is always done by one of my staff members. I don't have any contractors involved in this process, unlike many others. I think I can have a better control of the quality. They all work for me and just work for me only, doing depreciation schedules and for nobody else. And no contractors involved in any part of the process. Review what drawings and specifications are available. Things like, we don't send you off to the council to find the drawings or the age of the building or any of that sort of stuff. We actually can look that up. We can usually get your settlement date and purchase price sometimes if you don't find it easily. Most of the time we can get that. We'll look that up for you and try to make the process as easy as we possibly can because we need that for the report. Prepare the report, save you thousands of dollars hopefully, and send a copy to the accountant as well as the plan. We'll send him an email PDF copy of the report. The things that need to be included that are important. Now, the total cost for all of the items, obviously, and the rates that are available to them. We also put the actual effective life the tax office puts on these things on the reports as well, so you can sort of see how it's calculated. It's projected for a full 40 years, so you never have to come back and see me again, unless, of course, you're a renovator, because then you want to scrap and get the new stuff. But it's a 40-year projection, so you can see exactly what to claim every year. Now, I've got there diminishing value and prime costs. There are a couple of different methods that you can claim under. And there's also a pooling schedule for low cost and low value items that helps us to maximise the deductions. It's been around for quite a few years. Right when it came out, we actually put these things into our reports to claim them properly. Your accountant will look at these and see which is the best for your scenario and help you to claim, but we give you all of them. Split reports. If you're multiple owners in a property, you own part of it with your wife or with someone else or your mate, there might be 4 of you or 6 of you. We can split them up into the percentage of ownership which is a bit more difficult than just a percentage of the total deductions. You'll get more deductions if you split it up properly because the rules change slightly with lower value items and you get more deductions out of them, especially that pooling. It makes a big difference. So tell us if you own them split and we'll split them up for you. As I said, we provide a copy to your accountant. We also provide it in a format, well in Excel and also a CSV format it's called, where your accountant can often, if he has the right sort of software, directly download it into their software without actually having to enter it in. We're trying to get that across all the software companies. We've got it on some. We're the first to have it. I've had that for some time. We negotiated with the software companies over a few years to let them do it and build their part of it. But it is something that does save your accountant some time and hopefully use some money on the way through there. Education is a big key. Hopefully you've learned plenty about it today, but I haven't talked about your property specifically. Get estimates, get educated. Get an estimate of how much it's going to cost. Use the calculator, but look, it can be better than a calculator. Use the calculator, then call us up. Flick us a link to the property so we can have a look at some photos. We'll talk to you for free and give an indication of how much deduction should be there. You've got to crunch these numbers before you buy properties and make sure it's going to suit your situation. Maverick Newsletter, if you're not on it, you probably are if you actually got to this webinar, but if you're not on it, join it. It only comes a couple of times a year. If you don't want the other emails that come with it, you can just join Maverick. We write some stuff about depreciation, detailed articles about scrapping. Capital gains tax is always a question. The latest one, if you don't have it, download it from the net because it actually has a detailed analysis of how capital gains tax is affected by depreciation claims and gives you some real numbers to see how it works. There's an investor part on the website. You can get on, you can just talk to people online if you don't like picking up the phone. There's a multitude of things on YouTube and some social media you can go and have a look at to find out more if you do. Education is your key to working out exactly what it is. Now I've got a large bunch of questions here. I'll try to answer a couple of them if you just give me a moment to read them without being too specific. How far back can I actually claim? The answer to that is 2 years is very easy to claim back in the past. So we'll facilitate the report for your accountant to actually amend those previous 2 years very easily. I live in a remote area, and we've got Wagga here for this situation. Now, the closest office to Wagga is either Sydney or Newcastle, but we actually have guys also situated that work for us, full-time staff in, for example, Taree. We service areas like Tamworth, Wagga on a regular basis. What we do in those situations in all distance areas is, and South Coast is another one, which is not far away, is that we actually do a bunch of jobs together in those at the same time. We go to Wagga very regularly. We go to South Coast probably just about every week. So it's really easy for us to actually visit these areas on a regular basis because we have enough jobs. The fee is the same in those areas, but if you ring up and we're not going there till next week, it'll be next week before we actually do an inspection because I want my guys to do it so it's done properly. If you really want it tomorrow, I'll probably charge you some more money, I suppose, but usually a week's not going to hurt that. And once we do get it back, if it's taken more than a week that we're able to get in, then we'll just punch the report out a bit quicker when we do actually get it back. It takes about 7 days after we do the inspection, 7 days after do the inspection to actually prepare the report as a maximum, so you get it fairly quickly afterwards. Does the ATO charge to adjust previous tax returns? Good question. Well, your accountant will probably charge you or will charge you, sorry, to amend your tax returns. The ATO, as far as I'm aware, don't charge you to actually do that. It's just like they don't charge you to do a tax return at the moment. The accountant actually does. Do we have people in every state and in Queensland? Yes, definitely. Queensland, we've got Brisbane, Cairns, and the Gold Coast, and they travel up and down that coast. Is it worth getting a depreciation schedule done on a property you're completely renovating if you intend to sell it and then buy and sell it in the same financial year? That's a good question, actually. What we do in that situation is, if you're going to renovate it, and you rent it out first, then you look at it, you might be able to claim this scrapping. Then there'll be some depreciation that relates to the rest of that financial year. What happens in that situation is, we'll be able to, well, firstly, what you can do first is for free, ring up, get an estimate of what sort of deductions might be available, read up about the capital gains tax, or take the number off to your accountant as an approximate estimate. Make sure it's going to be actually worth it for you to claim these deductions based on the CGT and all capital gains tax and all those things. Then we then decide whether or not it's worth actually going ahead based on the amount you're going to get back. Purchased a new townhouse with a furniture pack, around about $20,000 to $30,000, and there's no question associated with that I can see. Sorry, I have to answer that one by email. I think we're bang on the time there. What I will say is that you can send in as many questions as you like or at any time really, now or whenever, about depreciation. We're happy to give you an estimate all the time of what sort of deductions might be there. It's very easy. The guys can usually do that pretty much over the phone if it's simple, or they'll have a look at the photos. Always ask questions. Always learn as much as you can before you actually buy it, the properties. And hope you guys all learnt heaps out of today. Look forward to helping you with depreciation schedules in the future. Thank you very much. Bye.